For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Yeah, podcast time. Wow. It just rolls around very quickly, doesn't it? Welcome. This is Managing Your Financial Future. Podcast host, that's me, Johnny Dean. Podcast co-host, guest, Rick the Professor Plum, certified financial planner professional, accredited wealth management advisor. Really co-host. You're not a guest. I mean, you're here all the time, Rick, so it's not like,
I'm
can't
always
call you
here.
a guest anymore. You are always here. And I'm always here. We've been doing this a long time. And speaking of a long time, hey, do you remember 1998? Now, I mean, the late 90s. It seems like it's such a long time ago now. Well, it does.
We were
It
just
is a
starting
long
to prepare for Y2K.
I know it. I mean, you're halfway through the second Clinton presidency. What else was going on? But I bring that up. Because that's the year that Roth IRAs came into existence. And by the way, the Roth was part of a bunch of great stuff that we got during the mid to late 90s. Gifts from the government, mainly tax related. Benefits that still continue, I think, to help us today, although the impact of some of them has been lessened somewhat by time. But, Roth IRAs, I mentioned those. Depreciation recapture. Now, you remember when that was a thing? I mean, it was helpful back then. But, I mean, anything prior to May 7th of 1997.
Well, that's only selling a property as a primary residence.
No, I understand that. I know, but you didn't have to.
And we got
recapture.
that in 97, not 98.
No, I know. I'm saying the mid to late 90s. This was an era where that happened. So, I mean, the May 7th of 1990, that thing doesn't even matter anymore. And we also got at around that same time the home sale exclusion, the $500,000 or $250,000 per married.
Yeah, the rewritten
person.
Section 121 primary residence exemption.
Section 1. Did you remember that, or did you have to look that up?
No, unfortunately, I remember things.
Dang,
I can't remember
man.
your name, but I can remember Section 121.
What with all that information in your head, what is missing? I mean, what vital pieces of things you
Common
really need
decency,
to know?
Social etiquette. Those things have gone out the window.
I don't know if they ever were there.
That's true too.
No, you're no. Anyway, okay. So, but this is the topic at hand, and those things. Of those things, the home sale exclusion, the $500,000 that we got, it was good, but it's kind of lost its impact somewhat.
Well, back
due
in
to
'97,
inflation.
when we first got the $250 per person up to $500 for a married couple, that was a lot of gain. Mm-hmm. Now it's like that's not as much gain like it used to. People have that, at least where I live, that's not a tremendous, a lot of people have more than that.
Yeah, well, and I sold my home where you are a couple of years ago, and I thought, well, it helped some, but it
helped
didn't
a lot
help like it used to.
But you still had some to pay.
Yeah, but there was a time when you had almost nothing to pay. Anyway, but the Roth IRA, and that's what we're talking about here. Roth IRAs have been wonderful tools to use. Now, I've said many times, Rick, the ideal situation for me would be to have all of my retirement savings money in a Roth. My 401ks, my traditional IRAs, our 403B that we have, even my pension, if a Roth pension could somehow exist. But of course, it's the cost of getting those funds under the Roth umbrella. I think we mentioned last week how everything good in life has a cost. Well, the enormous tax bill I would have to pay in order for that ideal situation to come true would almost certainly not be worth it. But it's one of the things you have to consider.
Advantage.
Yes, it's one of the things you have to consider when doing Roth IRAs. Now, Rick, when you think about it, that Roth concept, I don't want to say it sounds too good to be true because it is true, but the idea of paying taxes, now so that you don't have to pay them later is a pretty good deal. But and this is the part that often gets overlooked, there are rules to achieving that take it all out tax-free result of a Roth. You got to know the rules. So today we're going to talk about 3 Roth IRA rules that you really need to know. 2 of them revolve around this so-called 5 years, which we'll get to in a bit. It can be a little confusing. And then the third one has to do with required minimum distributions that you were telling me just before the show here. People find confusing. So, but okay, first, Rick, before we get to these rules, people sometimes tell us in a nice way that we occasionally talk about certain things, making the assumption that everyone knows what we mean or what we're talking about. These are things that we've discussed for so long and so often that it doesn't always. Well, that's it. It doesn't always occur to us to give the explanation. And I think Roth IRAs are one of those. So, Rick, in anticipation of listeners asking us about the workings of a Roth, please, let's start this off with the basic idea of a Roth and how it differs from a traditional IRA.
Well, they're basically 180 degrees opposite of a traditional IRA. With a traditional IRA, you get a deduction for putting the money into it, hopefully. Otherwise, why would you do it? So you get a tax deduction up front. Let me step back. There are three parts to what I'm going to talk about. There's the money going in to the account. There's the earnings while it's in the account. And then there's money coming out of the account. So when we look at them as steps, step 1, step 2, step 3. Step 1, put money in. Step 2, let it grow. Step 3, take it out. Step 1 for a traditional IRA is a tax deduction. You get a tax benefit, an immediate tax benefit for doing it. Step 2 is tax deferred. For 99.999% of the investments inside of there is no taxable event happening at the time that you're earning the interest, that you're creating the capital gain, that you're getting the dividends. It's all tax deferred. And then step 3, the distribution from a traditional IRA, that becomes a taxable event for the full amount. Tax deductible, tax deferred, tax free, or taxable. The Roth IRA is the exact opposite on step 1 and the exact opposite on step 3. Step 2 is exactly the same. So step 1 for a traditional IRA was a tax deduction. For a Roth IRA, no tax deduction. Step 3 for a distribution from a traditional IRA was taxable. Step 3 for a Roth IRA is no taxes, assuming you create what's known as a qualified distribution. You have to live up to the rules, and as long as you live up to the rules, you get no tax on the distribution. So, there, like I said, the money going in, tax deductible on one side, non-tax deductible on the other side. That traditional IRAs, basically. The middle section, tax deferred growth, that's the same either way. The distribution, exactly opposite. Traditional IRA taxable, Roth IRA non-taxable. Definitely favors the Roth.
Well, we love that taxable on the other side, especially if you have a lot of growth in that, obviously. And I guess the basic rule of thumb, here we go, was that if you need the tax deduction now, you have a better benefit. If it benefits you more now, take the deduction if you can with the deductible IRA now, and worry about taxes later at possibly a lower bracket. Or are you in a relatively low bracket now, maybe in one higher, and if so, the Roth will benefit. But okay, so now you said as long as it's a qualified distribution.
So
of
step 3,
Roth.
Taking money out of a Roth IRA to make it tax-free. And this is going to be, I'll put a caveat on that, because to make the earnings tax-free, you have to have had a Roth in your Social Security number, your name, for at least 5 tax years, and you have to be 59 and a half years old. This is an and, not an or. You have to meet both issues. Length of time that you've had Roth IRAs continuously, 5 years, 5 tax years, by the way, and then also 59 and a half. Mm-hmm. And a qualified distribution says that whatever you take out, any distribution that you take from your Roth IRA is tax-free, and you don't even have to account for it. It's just tax-free. If you have had a Roth IRA continuously for at least 5 tax years, and you're 59 and a half, the money coming out is tax-free. It doesn't matter whether it came from contributions. It doesn't matter if it was money you converted yesterday. It doesn't matter if it was money you've earned and it was capital gains, interest, dividends. It does not matter. If you have had any Roth IRA for 5 years and you're 59 and a half, you get qualified distributions. That's tax-free, baby. That's the good stuff. And it doesn't show up as part of your adjusted gross income and get deducted later. It's just a blessing, a wonderful blessing. Where people have issues is it gets very confusing when you want to or have to start taking money out of a Roth IRA before you have either 5 years or you're age 59 and a half. Because there are ways, unlike a traditional IRA, which is basically, for the most part, all pre-tax money. Hopefully, you have very little after-tax money in your traditional IRA. I did a training class this morning for advisors, and I harped on the idea that you should not, if possible, have any after-tax money in your traditional IRA unless you can convert it to Roth IRA tax-free. That's the only reason to have it. And so anyway, I've kind of been on my little high horse for that all day.
Well, it has to do with the headaches and the paperwork.
It's a major
and all that
pain
stuff.
in the backside. But you can start taking money out of a Roth IRA before 59 and a half, before 5 years, depending upon what you're taking out of the Roth IRA. And this is where it gets confusing because there's three potential types of money in a Roth IRA. There are monies that you have contributed. The money that I contribute out of my pocket to a Roth IRA, contributions. I can recover my contributions from a Roth IRA at any time that I want for no reason. I don't have to give a reason. I can take the money out and do whatever the heck I want with it. And when I recover my contributions, my cumulative contributions, it's no tax. I didn't get a deduction going in, and it's not a penalty. So that money is my money to do with as I please if I want to take it out. Now, I really don't want to take it out because I want to leave it in so that it can grow tax deferred and ultimately tax-free distributions. And the more money that's in it, the more growth I get. The more growth I get, the better my tax-free benefit is later on in life. I want to keep as much money in there as possible. But we all know that things happen that sometimes say, you know what? You need some money, dude. And where are you going to get it? And sometimes Roth is where you're going to get it. So if you take money out of a Roth IRA before you're 59 and a half or before your 5 years are up, it's still tax-free. Now, you have to account for it. You can't just say, well, I know it's my money. It's my contributions. And so I'm just going to take the money and I'm not going to tell the IRS about it because why should they care? It's not taxable anyway. Well, they do care because they're going to get a 1099 from the IRA custodian that says money came out of the Roth IRA, and the custodian probably doesn't know whether you're taking contributions or what you're taking out. So they're going to say it's a taxable event until you prove otherwise, and that's where you file a form on your tax return to say, yes, I received X amount of dollars from my Roth IRA. Keep your sticky hands off of it because it was my contributions, and you just fill out the form the right way, and you're good. You know, it's Form 8606, by the way.
And that's the headache form we were referring to a little while back. You know,
but it works, and it keeps their grubby hands off of your after-tax money. So you can get to the contributions anytime, for whatever reason, whenever you want. And then there are converted amounts, money that was in an IRA or a retirement plan that you converted to a Roth IRA, to a Roth account. And each of those has its own separate 5-year clock. And it's for the tax year that you did it. So if I did a conversion, and I'm under 59 and a half, let's say I did a conversion at age 50. It's the only IRA. I'm going to ignore contributions because I didn't make any contributions. I just converted $50,000 when I was 50 years of age. And then when I was 54 years of age, I paid the taxes because to do a conversion, I have to pay the taxes. So I paid the taxes. And now I've got $50,000 of conversion money in my IRA. And it's the only money in my IRA except for some earnings on it. And I say, well, you know what? I kind of need that $50,000 back. And 3 years later, I take the $50,000 out. I have already paid tax on it, so it's not taxable. But it will be penalized. You will pay an early distribution penalty. And curiously enough, in 1998, when they 1997, when they wrote the law for this to be Roth IRAs to be created in 1998, this conversion 5-year rule did not exist. And when we were reading the law that passed in 97, we devious little financial advisors are looking at this going, ooh, this is a way to get money out of an IRA without a penalty. We just do a conversion and then we can take the money out. Congress didn't do anything. Congress passed a law because they don't know anything about accounting. The IRS saw this and said, whoa, time out. And they put the 5-year rule in a contemplation type issue that said, you can't do this. You got to do this 5 years ahead when you want to do it. And so they put the 5-year rule in.
The IRS did that? The IRS
Congress didn't do it.
Well, that's interesting. I don't think I knew that. So they were the tattletales
Congress
in the
is
class.
dumb.
Says, teacher, you forgot to give us our homework.
Well, they said this isn't right because it's not allowed to come out of a traditional IRA without a penalty. And so by just being able to move it from point A to point B and then take it without a penalty, that kind of goes against the intent of the premature distribution penalty. So they went back to Congress and said, you got to do something about this, fix it. Yeah. And they said, okay, we're going to put a 5-year contemplation of penalty issue. You got to wait 5 years to get the money out, without a penalty. And so when we are taking money from a Roth IRA, the first money that comes out is the amount equal to my cumulative contributions. If I have no contributions, then I start taking money out attributable to converted principals. The oldest converted principal first. So maybe I've been doing conversions of $10,000 every year. As long as I'm started 6-7 years ago, I can take out $10,000 every year because I'm taking out the oldest one first. If it's older than 5 years, no penalty, no tax.
Oh, gee.
And this is actually a way for people to avoid using a 72T that want to retire early. And they call it Roth laddering.
Wait, hold on a second. There's another term, 72T. I mean, let's
a way to avoid the premature age 59.5, 10% penalty is 72T.
Yeah. Now, I just want to clarify. It can as I'm listening to this, and I know where you're going with this, but Rick, no wonder people are confused. I mean, 5-year rules for separate conversions, and you can take the oldest. There are ordering rules for taking money out of the Roth. I don't want to confuse people too much, but at the same time, this is an episode about the rules. So can we...
Okay, so the rules.
Can we boil it down so that people don't have to follow it as closely?
Sure. There's two different 5-year rules on Roths. One of them has to do with conversions, and that 5 years stays with each annual conversion or each year's conversions until you're 59.5. There is a 5-year rule, the overarching qualified distribution rule that says once you have attained age 59.5 or you're older, and you have had a Roth IRA, any Roth IRA, regardless of how it was created, for at least 5 tax years, then any distribution, regardless of whether it's contributions, conversions, or earnings, is a qualified distribution. That's the one you need to know.
Yeah, meaning tax-free. Yeah. Okay, so, I think most people's idea is that you put the money in the Roth, and you're 59.5, you can take it out, and you don't have to worry about a penalty. Is there ever a time, he asked in his most leading question tone, is there ever a time, and I think you just did explain this, but where you're over 59.5, but you're still going to wind up paying tax on a Roth because it's not qualified?
Well, you could, yes. I mean, if your first Roth IRA, let's say you're 61 years old, or you're 80 years old, and you have a traditional IRA, you're sick of the required minimum distributions, you've got a low income, and so you decide, I'm going to convert the rest of everything except for this year's RMD, I'm going to put into a Roth IRA this year. So I'm going to create a Roth IRA when I'm 80 years old. And I just happened to pick the best stock in the freaking world. And I did a conversion of 50 grand, and it's $200,000 2 years later. I hit it right, baby. And I think, wow, I want to take the money out and go on. I'm now 83 years old. I want to go on one round the world in 80 days tour, and it's going to cost me $200,000. I take the $200,000 out of my Roth IRA. I'm definitely 59 and a half, but I have not had a Roth IRA for 5 years. Now, I won't be penalized because I'm over 59 and a half, but that $150,000 of hypothetical earnings in this grandiose idea here is taxable. It's all taxable.
You haven't had it for 5 years.
Haven't had it for 5 years.
Yeah, it's just something. This is what people need to watch out for. Understand, just to boil it down a little bit further. Understand that there's a 5-year rule on Roths, and that's a contributory Roth or a converted Roth.
There's a 5-year rule on qualified distributions, and there's a 5-year rule on converted amounts.
Yeah, there you go.
Different rules. They just both happen to be 5 years. And that's the hard part. That's the only hard part. It's pretty easy, really.
Let's go to the other one because we don't have a ton of time left now. But let's go to the other one, the third rule. Those are the two 5-year rules. Okay. The required minimum distribution. Now, I will not assume that everybody knows that a Roth IRA for an owner, the owner of the Roth, when they hit age 73 or 75, does not have a required minimum distribution on that particular Roth or any Roth that they have, Rick. This is true not just for the owner, but if you happen to die and your spouse inherits it. Well, I'm going to let you explain it. Go ahead.
So, there's some misconception that, yes, if I have a Roth IRA that I created in my name, I never am required at any time in my life to take a distribution from that Roth IRA. A traditional IRA, yes, I am required to take money out of it, starting at either age 73 or age 75, depending on when I was born. There are required minimum distributions from traditional IRAs, but not from Roth IRAs. I'm never required to take money out of the Roth IRA. But things change potentially after I die. Now, when I pass away, depending upon who my beneficiary is, we have different rules. If my beneficiary is my spouse can roll it into their own name as if it was their Roth IRA from day one, and because they're the owner of it, they never have a required minimum distribution from that Roth IRA. But what if I'm unfortunately not married, or I'm a widow, or I'm a single person when I die, and I leave the Roth IRA to somebody other than a spouse? Well, the beneficiary Roth IRA rules, we still have a 10-year rule. We have the new 10-year rule. And I was actually having this discussion with another advisor the other day, and the way we treat beneficiary traditional IRA distributions and beneficiary Roth IRAs are different. We look at what is the best use of the money, especially from a tax standpoint. And with a Roth IRA, assuming you can afford to, if you are an inheritor from somebody other than a spouse of a Roth IRA, one of the best things you can do is leave it alone for 10 years. You do not have to take a distribution until December 31st, 10 years after the anniversary of the person that died. So you do have a 10-year rule. It's all got to come out after the end of 10 years. But the idea would be to try to grow it or build as much in there as possible so that when you have to take it all out at the end of the 10th year, you get as big of a bang for your buck as you can possibly get because it's going to be tax-free. I mean, if I'm waiting 10 years, by definition, I've passed every 5-year rule there is. And so that gives me the biggest. But with a traditional IRA, I don't want to do that. I don't want to just leave it alone for 10 years, most likely, because all that does is create this big ticking time bomb of a tax bill with a traditional IRA. So how we treat beneficiary IRAs is different than how we treat beneficiary Roth IRAs. But you do have the 10-year rule.
Have Roth IRAs, I can't remember, you would know, Roth IRAs for beneficiaries always had some sort of distribution?
Well, they used to have the same exact distribution. We'd have to stretch them.
Yeah, through your lifetime, right?
They had the same stretch rules that everything had back in the day before 2020.
Mm-hmm. So there was an RMD. Now people might ask, well,
the beneficiary Roth IRAs have always, non-spouse beneficiary Roth IRAs have always had required minimum distributions. They just changed a little bit after 2019.
Mm-hmm. Now, if you are a beneficiary and you're under age 59 and a half and you have a required minimum distribution, obviously there's not going to be a penalty on that. But
there is never a premature distribution on a beneficiary IRA.
Mm-hmm.
Death paid that tax for us. The death of the owner.
And in this case, there was no tax to pay, assuming the Roth was qualified. So,
right.
If you inherit just very quickly, we're just about out of time. But if you inherit a Roth that was not, say that 80-year-old, passed away and had all that gain, and they'd only had it for 2 years, and they wound
Leave it alone for 3 years, and then you get the tax-free treatment.
Yeah, you have to, right? Yes.
If you want to avoid paying taxes, you do. Going back to our hypothetical 80-year-old who did a conversion and started his very first Roth IRA at 80, grew it, quadrupled it in 2 years, and then because he was so excited to see the growth that he had a heart attack. And I'm sick, I know. And left it to somebody other than a spouse. The Roth IRA still has to have 5 year to get a qualified tax-free distribution. You still have to have 5 years, and if the owner didn't have it for 5 years, you need to satisfy that 5 year. Now, the basis is $50,000. The person, in this case, that hypothetical 80-year-old, did put $50,000 in, paid taxes on $50,000. So you can take the $50,000 out tax-free, but to get the earnings out tax-free, you'd have to wait till the end of the fifth year.
Mm-hmm.
After the end of the fifth year.
And that could trip people up if they don't know. I realize, folks.
I haven't actually run into that ever.
No, but it's a scenario. It's a scenario.
Could happen.
We haven't. I don't know any 80-year-olds that got a four-bagger.
And usually it's people that inherited at younger ages, like 45, 50, and there's not quadruple the amount of money, but there is some taxable. Person put in $8,000 this year, $8,000 next year. Not, let's go lower number, $7,000 a year for 2-3 years. They've put $21,000. It's worth. They put in 21. It's worth 25, and they're like, oh, Roth IRA, I can take the 25 out, but the person that owned it had not had it for 3 years, and it's not been 5 years since the very first tax year. That extra earnings would be taxable to the beneficiary, not penalized, but taxable.
Right. Okay. So just keep in mind that I understand this is the explanations can get complicated, and I
wonky is the right word.
Wonky, complicated, whatever you want. But the problem is if you don't understand or you're not aware of them, I mean, you can get tripped up. There are certain landmines that
pay some taxes when you don't necessarily need to pay taxes. I hate paying taxes, especially if I don't need to.
Well, of course, and somebody set up a Roth presumably so that they or somebody would have some form of tax-free growth and be able to take the earnings out tax-free, and Roth IRAs, of course, can be a wonderful tool, and certainly, as I said, one of the best places to have your funds sitting and or growing. I mean, tax-free growth, tax-free income in retirement. I think that's about as good as it gets. But
now, one area that gets people tripped up is when they have a Roth 401k, and they've been working long and hard, and they have a Roth 401k, and they convert it when they terminate. They move it to a Roth IRA.
Mm-hmm.
Well, and then they start taking money out of the Roth IRA, and they had the Roth 401k for decades, maybe a long time. And if they had taken money directly from the 401k, now we have parity in the rules, they could have taken qualified distributions from they're 60 plus years old, whatever the case may be. They could take distributions from the Roth 401k as a qualified distribution. But hey, they left the 401k and moved it to an IRA. Now it's not a qualified distribution because you haven't. You can still make it tax free, but don't ignore the accounting on your tax return. Otherwise, you're going to get a nasty gram from the IRS. And we've talked about it before. Even if you know you're right, you get that letter from the Treasury, and it's like, Uncle Sam wants to talk to you about your taxes. Your heart skips a beat no matter what. And even if you're right. And even if you can tell them, no, here's what happened, about why go through the hassle? Just make sure you do it right.
I have an envelope from the IRS that I got just on stuff I had requested like 6 months ago. I look at it and I still think, oh.
And you requested the information.
And I wanted the information. That was 6 months ago. All right. So to boil this all down, you got the 5-year rules, on converted or on contributory Roth. And, of course, the required minimum distributions. Those are the things that you really need to know. And I don't want to confuse people. Maybe we did, but at least if you know that there are rules out there and you are in a situation with a Roth, one of the ones that we described, have your advisor talk to you about these kinds of things. I mean, none of these rules are deal breakers, and they can actually open up planning opportunities, but you need to know how they work so you don't end up paying taxes or potentially penalties that you didn't expect. Now, all this complicated stuff, as you might have guessed, is pretty basic for Rick Plum and the advisors at Lucia Capital Group, mainly because they go through these procedures with their clients all the time. So, if you'd like to walk through how Roth IRAs fit into your overall plan, conversions, withdrawals, whatever, just make sure you're using them the right way. Reach out to the team at Lucia Capital Group, 800-644-1150. That number again, 800-644-1150. Visit online, luciacap.com, LUCIACAP.com. While you're there, take a look at our guides. Those are very popular. Download them to your heart's content. We got rollovers, retirement income, Social Security, bucket strategy, estate planning, maybe one or two others. But these are all designed to help you connect the dots, and you could read them at your leisure. Don't forget, subscribe to the podcast, Apple Podcasts or Spotify, so you don't miss an episode. We're always talking about topics that can help you, I think, better understand how all of this works together. And if not, call them at Lucia Capital Group. They'll help you out. We call it wealth education. I think that's exactly what this is. We are out of time. Thank you so much for Professor Rick Plum, certified financial planner, professional, and accredited wealth management advisor, managing your financial future. I am Johnny Dean. Thanks so much for listening. We'll talk to you all again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution, RMD, and in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. A plan participant leaving an employer typically has 4 options and may engage in a combination of these options. 1. Leave the money in their former employer's plan, if permitted. 2. Roll over the assets to their new employer's plan if one is available and rollovers are permitted. 3. Roll over to an IRA. Or 4. Cash out the account value. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Distributions of principal from a Roth 401k are tax-free. Any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth 401k was established, whichever is longer. Your investment options are limited with the Roth 401k to those offered by the plan administrator. Charges and fees may be incurred. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.